Hello and welcome to Earnings Echo. We put together the most important information about Microsoft. Today we are looking at a stack of sources, including their Q3 fiscal year 2026 earnings report, the call transcript, and a highly specialized valuation analysis.
Right.
Our mission for this deep dive is to cut through the staggering financial numbers, to discover if Microsoft's massive AI investments are actually paying off and exactly what the market is pricing into their stock right now. Let's start with the hard facts.
Well, the raw numbers are operating on an entirely different scale. They reported $82.9 billion in revenue for the quarter. EPS beat consensus slightly, but the stock actually traded flat, slightly down in after-hours trading.
Which implies the market is hesitating. Why did the numbers turn out this way?
It comes down to the sheer scale of the AI growth versus the cost. Their AI business just crossed a massive $37 billion annual revenue run rate.
Wow.
Right, that is up 123% from last year. It is a massive operational driver.
Okay, let's unpack this. Because, the top line is undeniably exploding, but the cost to support that explosion is equally staggering. Capital expenditures, CapEx hit $31.9 billion just for this quarter.
Yes, mostly on physical infrastructure like servers and data centers.
And management projects, they will spend $190 billion for the calendar year. Imagine building a massive $190 billion fleet of airplanes before you've even sold a single ticket. You are just betting that the passengers will show up.
It is a massive upfront capital commitment, exactly.
But with extreme spending like that completely distorting the cash they actually have on hand, how can investors possibly figure out what the company is actually worth right now?
That is the core valuation challenge. Normally, you value a company based on free cash flow, right? The actual cash left over at the end of the year.
Right.
But because Microsoft is spending tens of billions on servers right now, that cash pile looks artificially small. If you run a standard free cash flow model, it just breaks. It ends up demanding an unrealistic growth rate of over 50%, just to justify Microsoft's current $3.17 trillion market cap.
So if traditional math is broken, what do we use instead? The valuation analysis in our sources points to a reverse DCF. How does that fix the airplane problem?
Well, a reverse DCF flips the script entirely. Instead of guessing future cash to find today's price, it takes today's price, that $3.17 trillion market cap, and works backward.
To see what kind of growth Wall Street is already expecting.
Exactly. And importantly, it uses net income instead of free cash flow. Because when you buy a server or an airplane, you spend the cash today, but on your income statement, you spread that cost out over its useful life, say 15 years.
Through depreciation.
Yes. Net income captures that operating earning power much more cleanly, without being heavily skewed by this immediate cash drain.
Got it. So working backward from their price tag, what specific growth rate is the market actually pricing in?
What's fascinating here is that the reverse DCF shows the market expects an 8.7% net income growth every single year for the next 10 years. And given that their current net income growth is running around 23%, an 8.7% hurdle appears pretty moderate at first glance.
Here's where it gets really interesting. Achieving an 8.7% growth rate every year means Microsoft has to more than double its net income from roughly $131 billion to nearly $300 billion in a decade.
Right.
That runs directly into the law of large numbers. It is easy to double your revenue when you're making $1 million. It is incredibly difficult to find an extra $150 billion in pure profit. Furthermore, their profit margins are already sky high at 40.5%.
Which means there's very little room left to squeeze out more efficiency. This growth has to come almost entirely from selling new products.
Exactly. Did the sentiment on the earnings call reflect this tension?
It did. Management was highly optimistic about long-term AI monetization. They mentioned Copilot seats are up 250%, but they explicitly acknowledged severe capacity constraints.
Meaning I literally cannot build data centers fast enough?
Precisely. They expect to remain constrained on AI infrastructure through at least 2026. This indicates that their $190 billion CapEx bill isn't speculative. It's a mandatory requirement just to meet demand that is already outstripping supply.
So what does this all mean for you, the listener?
Synthesizing all these sources, the long-term investment story is that Microsoft is currently fairly valued. It's not a bargain, but it's not overpriced either. The valuation prices in solid, sustainable growth.
Assuming you believe the AI investments will translate into durable revenue streams.
Right. If you believe that, the premium makes sense. However, if that spending fails to normalize, or those 40% margins eventually compress under the weight of maintaining all these data centers, the stock offers very little margin of safety.
Which leaves you with a critical and perhaps unsettling question to ponder on your own. Are these massive server bills just a temporary build-out phase for the AI revolution? Or is this relentless cash-draining infrastructure spending simply the new, permanent cost of doing business in tech?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information. It does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.